All right, welcome to Lecture 5. This is the Deathmatch, the boxing match, the UFC cage match between techs and fundies. So there's just a never-ending battle in the investment world between technicians and fundamentalists. And people like to put themselves into one of two camps. Usually it's technical analysis is absolute voodoo or technical analysis is God's word. And we talked about in Section 1 how we lie in the middle. And when you really look at it and distill it down at a high enough level, both of these things really represent the exact same thing. All right. So they're all technicals and fundamentals. They're just data points that you put into a process, and they're virtually the same thing. You take all this stuff, you put it into a model, you crunch it into a signal, and you make a trade. So the price of an asset, right, that can trend. Fundamental metrics can also trend. And if you turn fundamental analysis down into quant fundamental data, it's a time series just like a price chart. So at the end of the day, it's really all just the same thing. I mean, look at crude oil futures, right? We have time on the x-axis by price on the y-axis, and it's just recording what happened on each date. And here's some macro fundamental data, and this is percent unemployment, right? But what is it? Just an x-axis showing time by a y-axis, right? So it's just recording what was the unemployment level during each time period, right? And then here's micro fundamentals. These are two metrics, revenue and EPS, that fundamentalists like to look at a lot. But again, it's just a time series. It's an x-axis showing time on a y-axis showing what these values were at that moment in time. So at a high enough level, price action is very similar, if not the exact same type of input as a fundamental input. They're both time series. All right, so when an analyst looks at data, that data creates a story based on the analyst's mental model. So, and it doesn't matter whether he's looking at a 10K, he's looking at quant fundamental data, if he's a technician viewing a breakout, it's going to form a narrative in his mind. And in both cases, he's using his mental model to shape that narrative based on the data coming in. So you could be reading a 10K and looking at top line revenue numbers and forming a certain assumption about the company. Maybe you really like this industry because the revenue is growing. Or you could be looking at a chart and you can really like the industry because it's trending up or it's breaking out. And we see actual demand in the market for it on the chart. And so it can even be argued that the fundamentals manifest themselves in the charts. So these analytical techniques go hand in hand, and that's why we get back to the emergent property, which we talked about earlier, is a chart ultimately shows buying and selling from everyone, including institutional investors. And a lot of these institutional investors are acting based on their opinions of the fundamentals at the time. So in effect, it's elephant tracks of these big, large institutions being placed right there for you on the chart. So the fundamental information, the way that people are thinking about the world, the mental models that those big players are using to interpret the world's fundamental data, it's being disseminated anyway on the price chart through their buy and sell orders. So we have this constant relationship between price action and fundamental data. And that's why we like to look at them both simultaneously. Now, at the end of the day, the fundamental camp, in our opinion, is a little more arrogant because they think that just by studying some data that is proprietary to them, or perhaps data that's not as widely studied, that they can come up with a conclusion that is completely correct. And that's not the case because markets aren't perfect, fundamentals aren't perfect, and you're never going to have more than 70% of the actual picture. So if you really believe in your thesis or narrative, that exposes you to a blow-up because the chart can continually trending down, price action can continue to be going against you, and you will still have the position on because you believe in your narrative. But that narrative might not be correct. So there's always going to be things that you won't know and can't know. And you need to be aware of that fact. And when a move occurs, realize it's at least partially due to unknown reasons. And Paul Tudor Jones talked about this, especially when it comes to trading macro, where we never really have a complete information set about what's going on in the world. So it could be argued that if you did extreme due diligence on a very small company, you might be able to know exactly what can happen with that company. And even then, that's a stretch because there's always unknown events, unforeseen shocks that can come in. But with macro, when we're talking about these really high level concepts, like how is Yellen's rhetoric going to affect the Euro USD cross, or is Draghi going to come out and change his language a little bit, and is that going to affect the yen somehow? Well, that's a much more complex relationship, and we're just never ever going to be able to know with 100% accuracy what a central banker's rhetoric will do to a market. So that's why it's critical for especially macro investors to pay attention to both the chart and fundamentals. Now, from a value investor's point of view, they can use price action to actually sell at a more optimal point instead of what they deem as fair value. So they have the opportunity to look at technical analysis and say, hey, when the market approaches their quote unquote fair value number of, in this example, $50 per share, but continues to shoot higher, why should they sell? Because the chart's showing that the asset is still trending up. And that's a great question to ask yourself, because at the end of the day, fair value does not equal market value. Market value constantly fluctuates around quote unquote fair value, and fair value itself is transient. So if market participants are continuing to push prices higher, the stock could be worth way more than what you thought it was. So unless there's an overwhelming fundamental reason to sell out, you can accept that there's an unknown driver and just let the thing ride, and instead defer to price action to sell on weakness when it's showing to you that it is overvalued, or investors are stop bidding that play up. So this comes into the concept of play the player, and it's why we need to constantly be looking at both fundamentals and technicals, because value technically isn't a real thing. It's a concept that just fluctuates depending on the opinions of the observers. So value depends on not only your opinion, but the opinion of everyone else in the game. So the trick is to avoid playing the stocks themselves, and instead you need to play the other players in the market. And so fundamentalists, when they go in and buy a value play, they're expecting that other people are going to come onto their side of the boat and eventually share the same opinion as them. But price action can also help us find that out, because the chart can tell us, hey, if something's trending up or going up, well, obviously the market is sharing a similar opinion to us if we're thinking that it's a bullish story, and vice versa for a bearish story. So price action helps reveal the thinking of the other players and enabling us to be congruent with that and coherent with that and stay one step ahead of them. So it's better to think about the market as a giant poker game, but way higher stakes and more embedded complexity, because it's a mind game between all participants. And Keynes was actually one of the first people, the famous economist, to define the game in this fashion with his beauty contest example. So here's the beauty contest. I'll read the example here that he wrote. So competitors have to pick out the 6 prettiest faces from 100 photographs, the prize being awarded to the competitor whose choice most nearly corresponds to the average preferences of the competitors as a whole. So that each competitor has to pick not those faces that he himself finds prettiest, but those that he thinks likeliest to catch the fancy of the other competitors, all of whom are looking at the problem from the same point of view. We have reached the 3rd degree, where we devote our intelligences to anticipating what average opinion expects the average opinion to be, and there are some, I believe, who practice the 4th, 5th, and even higher degrees. So this is exactly what the market is, right? We're trying to assess whether or not everyone else thinks that this stock is bullish or bearish. Not necessarily what we think is bullish or bearish, because what we think doesn't really matter. We need other participants to come onto our side of the boat and believe that part of our thesis to eventually bid the stock or sell the stock into the direction that we think it's going to go. And that's why price action is so important, because it's a simple way to let us know, hey, are we with other competitors? Are we with average opinion, or are we against it? So at the end of the day, though, if we had to pick one thing to look at, you held a gun to our head and said, hey, are you going to be a technical analyst or fundamental analyst, or just study price action or just study fundamentals, we would choose price action over the fundamentals. Because at the end of the day, account statements just don't care about fundamentals. If you think about what's on your account statement, right, you have a bunch of line items that are just buys and sells on trades at certain prices, right? So maybe we bought it $1, we sold it $2, we bought something else at 10, we sold it at 8, and all we see is a line of transactions on our account statement, right? What we don't see in our account statement is our beautiful thesis about, what was going to happen to Apple stock, or our brilliant sounding macro thesis about, how all these factors are going to come together to create a huge crash. That's not on our account statements, only the cost basis and our buys and sells. So price action is much more visceral and connected to what actually shows up on our performance in our account statements. So fundamentals are really just a means to an end, right? They're not the actual thing that makes you win. Having good performance in the market is not about writing the best story, right? It's about buying and selling at higher prices, or shorting and carving at lower prices. So performance is based on what happens with the price action, nothing more. And I can't stress this enough. Performance is based on what happens with price action, nothing more. Okay, fundamental developments don't even matter if they fail to affect the price. So you could have an extremely involved thesis with a bunch of catalysts lined up, and when they come out and they fail to affect the price, you're not going to get paid for it. You're not going to get paid for it. So that's why at the end of the day, we are absolute slaves to the tape. And Paul Tudor Jones, again, he comes out and says this. He spends a significant amount of his time on analytics, collecting fundamental information to get the best edge he can possibly obtain. But at the end of the day, he knows that he's a slave to the tape and proud of it, because the tape is what pays you. If your stocks go up and you bought them, you get paid. If your stocks go down and you shorted them, you get paid. It has nothing to do with how cleverly crafted your thesis is, which is why at the end of the day, price action is king. So price action also plays into just every analytical technique, like we talked about earlier with that emergent property. It's constantly affecting the fundamentals, and it's showing up in fundamental metrics like PE ratio, PB ratio, other fundamental metrics, etc. Those all take in the actual price as an input. And on top of that, price action has to do with positioning. So the longer the trend, the more investors are on one side of the boat. It can show you pain points. Are the bulls or bears in pain, right? You can tell just by looking at how long something's been trending. And then sharp moves. So how fast something moves can be indicative of how crowded is and how popular is this opinion. So if it's extremely popular and all of a sudden it turns unpopular, investors need to liquidate all at once and very quickly. So price action can give us clues into every area of analysis. So that's why we consider it the absolute king technique. So in our opinion, every investor, trader, participating in liquid markets needs to have a method for organizing price action. It's that simple. It is the most robust and efficient way to take in the vast amount of data out there and distill it down to buys and sells. So the billionaire traders and funds have confirmed our opinion, right? We've seen this since the beginning of time, that guys like PTJ, Druck, even Renaissance, Quantum, all these funds really looked at price action and took it into account and held it as something extremely important to one of the inputs of their process. And then finally, respecting price keeps us honest, because we'll never know all the answers. Despite how much digging we'll do in the fundamental process or how much analysis, we're never really going to know all of it. And it keeps us honest. And that plays into one of our philosophical tenets of market speculation, which is being fallible. So realizing that no belief, theory, views can ever be rationally supported or justified in a conclusive way. And there's always going to be doubt to the truth of the belief. So no matter how much digging we do or how much time we spend on our process, we have to realize that it still could be wrong. And price action is a way to easily let us know if we are wrong, and so we can act upon it. And George Soros was extremely fallible, and he really liked to follow this philosophy, and he's quoted with saying, "I'm only rich because I know when I'm wrong. I basically survive by recognizing my mistakes." So Soros was notorious for doing a ton of due diligence on something and then completely reversing position or cutting it in the case that price action proved him wrong. So he knew his beliefs on where price should go can never be 100% proven. He knew that no matter how much legwork he put in, how much due diligence, there was never a quote-unquote sure shot, because we're dealing with a complex system. So this allowed him to transcend his own ego and just completely exit positions if they moved against him. And if proving wrong, he would switch sides to become right. So he would actually switch his position 100% completely around the other side. And that was part of the reason why he was such a successful speculator. So there's this great story of an old trading partner at Taleb's, a man by the name of Jean-Manuel Rozan, who spent an entire afternoon arguing with Soros about the stock market while they were playing tennis. And Soros was a huge bear, vehemently bearish with an elaborate theory as to why the market would go down. And then after the tennis match, they went home, and instead the stock market just ripped absolutely higher. And Jean-Manuel ran into Soros later and asked him about it, like, hey, did you get your ass kicked? Like, what happened? And Soros replied that he actually flipped sides, went long, and made an absolute fortune. And this is classic Soros fallibility, and is why he was so great. He was able to have an extremely elaborate theory as to why the market would go down. But when price action proved him wrong, he was able to immediately discard his theory, exit position, and even flip if he thought the case was so compelling and the price chart was so compelling that he could flip and take the other side. So using price keeps a trader's convictions in check, and it helps us stay fallible. So any trader should just be exiting his position if the price doesn't confirm his convictions. And this is something that fundamentals can never give you. And new fundamental information can come to light that does go against your prior thesis, but price is a much more pure way of telling you that you're wrong and you should head for the exits. So, let's say, for example, you're all hyped up about Twitter and they were coming out and they had their IPO and you bought in and you're extremely excited about the product and you thought it was the best thing since sliced bread and you wanted to bet really long, but then this happened, right? And we trended all the way down to 1766. So if you believed in your story and you had bought it up in this area, you'd be down a ton of money. Unless there's some place along the way where an earnings release or something else will come out and say, hey, I'm not quite a believer in this anymore. But if you're paying attention to price will tell you way farther in advance that you're wrong. The market doesn't believe in your opinion that Twitter is going to be an $100 stock. And it offers you an opportunity to exit and take a small loss before you take a large one. And so another thing that price action helps us with is this concept of perspectivism. And that is the fact that no way of seeing the world can be taken as definitely true. Once again, just because we think something can go up or go down, it can't necessarily be proven that our perspective is necessarily correct. And we have to be aware of that. We might have the wrong perspective. So personal views, if you think about it, those are based on historical context, mental models, past life experiences, culture, education, etc. And everyone has a different set of these. And we have to realize that. And that's why, two people can look at a particular asset or stock and say, I'm extremely bullish on this or I'm extremely bearish on it. And there are many factors that are influencing this decision for both parties. Here's a funny little graphic, of the optical illusion. This guy's saying, there's 4 bars here. And this guy's saying, no, there's 3, right? And which perspective is correct? Well, there's really no way of knowing. There's no absolute truth in this situation. Okay, from this guy's perspective, it's 3. From this guy's perspective, it's 4. And the same thing goes in the markets. So the markets are neither right or wrong. They simply are. When you're looking at the markets and you think that, hey, price action or a stock should eventually go up and price action is not believing in what you think, then it's not you being wrong or the market being wrong or the market being right. It's just existing. So price action helps us take this higher level concept of perspectivism and make it easy, right? We can say, hey, the market's not agreeing with this right now, exit the trade. This leaves us with this last interesting insight into how money's actually made in the market, and it ties back into Keynes' beauty contest. And it's to be on the side where perspectives converge. So price action can signal where perspectives are shifting and when they're about to when the market's perspective is about to converge onto your perspective. So if we have these two levels here, we have your perspective, the way you're looking at the market, and then we have the market participant's perspective. So we make money when this perspective converges into our perspective. Not if our fundamental thesis is correct or not correct. It's just if the market participants start to look at something, start to look at a picture in the same view as us. So if we're bullish bonds and we say, hey, U.S. Treasuries are going to go up because of XYZ factor, and the market doesn't think so, well then U.S. bonds are not going to go up. right? Because we need the market to come in and realize read the same data and realize, hey, this perspective of bonds going up actually is correct, and they start bidding it up, and then you capitalize on the further gains of that asset getting bid up. The game is a convergence and divergence of perspectives, and that's how money is won or lost out there on the market battlefield. And having price action available to us really does help us to distill this down to something extremely simple instead of high-level theory that's hard to execute on.